Jerome Powell with the Federal Reserve raises interest rates again. Again, guys, this is I think is like the 11th time since the pandemic, since they've been starting to raise it ever since the pandemic, and it doesn't seem like they're going to be stopping. He's been keeping the door open. They're going to keep doing this. So we just got to keep knowing exactly what this does. It affects our money. So again, I don't want anybody messing with my money if we don't have to. So let's get into the details and really see what's going on here, guys. But welcome to Getting to the Facts. Again, I'm your host, Andrew Curiel. We're going to get the week started off right. I know it's Monday. We're probably all a little bit tired from the weekend. Hopefully everyone had a good weekend. So let's just hop into this story, guys, and see what we got going on. But here first, we got from CNBC, Fed approves hike that takes interest rates to highest level in more than 22 years. The Federal Reserve approached a much anticipated interest rate hike that takes benchmark borrowing costs to their highest level in more than 22 years. The quarter percentage point increase will bring the Fed funds rate to a target range of 5.25 to 5.5%, which that isn't that's different than what your mortgage rates are and your auto loan rates are. Okay, the Fed fund rate, that kind of, it's it's something that the auto loan industry and the mortgage industry look at very closely, but there's other factors in why auto loan rates and mortgage rates keep going up or down or fluctuate a little bit more than the Fed rate, because the Fed, that they're really just setting the benchmark of what borrowing costs are going to be for banks and people giving out loans and things like that. So that's why that matters a lot. But we're going to keep going down here. Chair Jerome Powell said the central bank will make data driven decisions on a meeting by meeting basis. And we'll go right down here as well. Markets were watching for signs that the hike could be the last before Fed officials take a break to watch how the previous increases are impacting economic conditions. While policymakers indicated at the June meeting that 2 rate rises are coming this year, markets have been pricing in a better than even chance that there won't be any more moves this year. Okay. During a news conference, Chairman Jerome Powell said inflation has moderated somewhat since the middle of last year, but hitting the Fed's 2% target has a long way to go. Which, if they're trying to get down to 2%, I really don't know why they're trying to say there might not be another increase this year. There's almost for sure going to be at least one more increase this year. They still have 2 or 3 meetings before the end of 2023. And if we're not even close to 2% when it comes to this inflation number, I really don't understand how everyone's thinking it's just going to stay stagnant. But we'll see. I would say it's certainly possible, and this is a quote from Jerome Powell. I would say it's certainly possible that we will raise funds again at the September meeting if the data warranted. Thank you, said Powell. And I would also say it's possible that we would choose to hold steady, and we're going to be making careful assessments, as I said, meeting by meeting. So really, guys, Jerome Powell's just keeping all the doors open. He's keeping everything open so nobody can corner him and saying, but you said, which is actually smart. I mean, he's in a position where he shouldn't be guaranteeing anything unless he knows for sure that he's going to have to do something. But based on both of those quotes right there that he said in his conference, I'm really leaning towards him thinking that it's like a 55 to a 65% chance that we're going to have to do another 0.25% increase, which is it's just nuts. That to me, guys, I mean, especially when we take a look at this, it really tells me that they're trying to hold this economy up by a thread. Like, they're trying to do everything they can to tamper inflation as much as possible, without crippling our economy and putting us into a deep recession. And it just seems that we're on thin ice. And I don't know. I mean, that's why I want everyone to kind of do their own research, to know what the hell's going on, guys. Because this is just, the things that are going on are just weird. Like, we're printing more money than we've ever printed in the history of the United States since 2020. And that was under the Trump administration and the Biden administration because of the pandemic and everything. We've been printing money out the ass, and then we're just giving we're going to be hitting 100 billion at some point in this Ukraine war, and that's only been a year and a half. So we keep printing money, let the printer go, and at the same time, we're also raising rates to tamper inflation. Those are like contradicting things or what's going on, guys. So it's just really weird, how we aren't really paying attention as an average person. Yeah, do we say it's more expensive to buy a car? Yeah. Do we say it's more expensive to buy a home? Yeah. But do we, is it pissing us off enough to vote a different way? Like to actually get people in power that aren't just going to be establishment politics. And I'm not talking about just voting Republican or just voting Democrat. I'm saying let's get the hell out all these establishment politicians. Get them the hell out. Okay, they're messing up our money. They're messing up with our personal freedoms and our personal liberties, and our personal pursuit of happiness, which is exactly what the United States stands for. And we got to do something about it, guys. You know, and the only way that we do something about it is we all got to stand up. If we just have a couple million people be on the same page and get upset and start boycotting things and doing different peaceful protests and different things like that, things will change. But you also need to start voting in people that are actually going to be for the people again. So that's what I'm saying. We need to wake up on who we're electing. Let's actually Google some of these new names coming up, some of these young people coming up for these elections, and really see what they stand for. Do they have big multimillionaire, billionaire super PACs and different things like that that are giving money to their campaign? If they're doing that, they're most likely an establishment politician that's just going to go into this lobbying type of way of doing things. As long as you give me a couple of million for my campaign, I'll help you out. And that's what we need to get away from, because this is just getting dangerous, guys. I mean, you're messing with our money a little too much. The average person needs to be able to buy things. We need to be able to buy a new car whenever we need to, when our cars break down. Like, we need to be able to buy a home. But that's the thing. Do they want us to buy a home? Because the majority of the smart people in this world know if you buy a home, it gives you the outlet to start building generational wealth. It doesn't guarantee it, but it finally gives you an opportunity to start building towards it. But we're going to watch this little clip here too, guys. I actually was able to find this here, and it's just a little breakdown of really what's going on. It's only like a minute and 10 seconds. All right. So it'll just give us a little bit more clarity on this Fed rate hike. So let's watch this real quick.
Announcing its decision on interest rates now. The Fed will raise rates by 0.25% in line with what analysts were expecting. That decision coming as the Fed remains hopeful that inflation will continue to cool off. ABC News business correspondent Alexis Christoforous joining us with the breaking news. Break down the breaking news for us, Alexis.
All right, I'd be happy to, Kira. So this is, if you're keeping track, the 11th interest rate hike from the Federal Reserve since March of last year, and it takes the Fed's key short-term interest rate to its highest level in 22 years. And perhaps even more importantly, the Fed left the door open today for future interest rate hikes. They're just not sure they have fully tackled inflation just yet. We know that inflation is cooling. It's now at 3%, down from more than 9% in June of last year, but still not at that 2% level the Fed is looking for. Today, the Fed describing economic growth as moderate, but said it will continue to monitor the data when it comes to future interest rate hikes. Some on Wall Street believe we could see at least one more before the end of the year. Kira?
Thank you. All right, Alexis, thank you.
Guys, I mean... Again, they've just been trying to racket it up so we can stop spending. And it's just something that it's something that we need to be able to do. Like, I'm not upset that the Fed is raising rates. I'm upset with how quick they're doing it, because this is kind of unprecedented on how quick they're raising the rates, which makes me worry that there's something deeper going on. They wouldn't be raising these rates this quick for no reason. And that's the thing that's concerning. And the fact that still, after 11 rate increases, they're still not going to say they're done. And again, guys, when we're talking about this too, it's the stagflation is going to hit. When stagflation hits, that means the rates aren't going up, the rates aren't going down. It's just going to be stagnant. So we're going to be sitting here with these high interest rates for at least a year or two once they decide to stop. once they decide to stop, because it's not like, I mean, the target for the Fed to get down to 2% inflation, and obviously 2%, that's not even the right. I hate when they go based off those, because that means it's a year by year rollover. So they just don't want the inflation to increase more than 2% from the year previous. But that doesn't mean that's the total inflation percentage, which gets a little confusing for the average person. So again, guys, just got to look this up, because inflation is higher than it's been since the 80s. Since the 80s, guys. And we're going to show this here too. I was able to find this little, and actually, I went back to it because I showed this in a previous podcast to you guys, but now you get to see the full thing now that I got my my articles working. But here you see what the 30-year fixed rate was on the average, right, for the full year, starting from 1975. 1975 was 9%. It hit its peak in 1981 at 16.63%. So yeah, was a house $80,000? Yeah, it was. But with a 16.63% interest, guys, I don't know if you know anything about loans. No one would be able to qualify unless you had money. Like, no one was buying a house from, no one, I mean, honestly, I would be shocked if people were buying a house from 79 all the way down to 85. Even 86, you're still at 10%, 10% all the way until 1991. You know, and then finally my birth year in 1992, we finally get a little reprieve and get it back down into the eights. But, you know, it's just nuts. And then if we just go here, guys, even right here, we had the lowest rates on average at 2.96%. And now the current year 30-year mortgage is a 7.27%. That's average. Like, guys, even a 15-year fixed mortgage, is still a 6.56%. To keep it into context, I bought my house in April of 2020, okay, a month into the pandemic, and I got a 3.59% interest. And I actually refied. I refied my home and was able to pay off a couple bills and all that stuff. And my home, my interest rate went down to a 3.49%. And that was December of 2021. So just in a year and a half, basically a year and a half, it's gone up double. It's gone up more than double almost, right? Yeah, it's gone up more than double in a year and a half. That is just insane. Absolutely insane. I mean, and even compared to 2022, what the average was in 2022, it's almost up a full 2% from just last year. And they're still not saying that they're done raising the Fed rates, because again, guys, if you raise the Fed rates, the mortgage rates are going to go up, because again, the Fed, that Fed funds rate, that dictates to banks what they're going to be able to get loans for, or put out loans for, because they're the ones giving out this money for different investing opportunities or buying a home, which is an investment opportunity, all those things. So that's why it matters so much when the Fed raises these rates, because it is something that immediately affects the mortgage industry and the auto industry, which are two huge industries for the average people, you know. And again, since we're talking about this too, I pulled up the auto loans rate, and this is a 60-month auto loan. Guys, the majority of average Americans in this country are getting 72-month loans. Okay, they're not doing a 6-year loan no more. It's a 7-year loan, because they have to, because of the cost of these cars and everything. I mean, they have to. But with how crazy these rates have gotten, guys, I don't know how people are buying cars. Like, I really don't. Look, this is from January 2014, right at 4.25%. Okay, and we go all the way over. Even here in September or August of 2021, it was at a 4.15. And then all of a sudden, we start going on this uphill come April of 2022. So again, only like 1 year, okay? And the rates have gone from 4.47 all the way to 7.14%. That's like a 40 to 45% increase in a year. A year, guys. Like, please, like, we got to pay attention to this stuff. Because again, I don't understand with how much cars are costing these days. And again, or actually, and I'm sorry, when I said a 6-year, they're doing a 7-year. I'm saying that was a 5-year loan, a 60-month car loan is a 5-year loan, and then they're actually doing 6 years. So my mistake on that, but it still goes. And when you go to a higher duration for the loan, like more months on the loan, your interest rate's always going to be higher. So if we're at a 7.14% for a 5-year loan, you're at almost like a 7.3 to a 7.5% for a regular 6-year loan that people are getting. And guys, we're just talking about 1 year. 1 year, and they're not done. They're not done. This is gonna at some point, I feel like they're not going to stop. And this is my personal opinion, okay? Take it with a grain of salt. But this is my personal opinion that I don't think they're going to stop until they hit this wall that is going to drastically affect a lot of markets. And if those markets get affected too detrimental, it's going to tremor out to the rest of the economy. And it's going to scare the stock market. And if the stock market gets scared and people pull out money and different things like that, that's when we start seeing a tsunami of things happening. So we just got to pay attention on what's going on, guys. So I hope you like the content. Again, I just want to make sure we all just have a little bit more knowledge on things that I think we should all be paying attention to. And when it comes to our money, that's the one thing that I'm always going to say I'm going to want a little more information on, because I'm tired of people messing with my money. Okay. Like I'm making more money than I've ever made in my life, and I still feel broke now because of how much things are costing. Like it's absolutely insane. So stay up, guys. I hope you have a great start to your week. Again, make sure we smash that like button, subscribe to the channel if you haven't already. Again, I really appreciate you guys, and we're just going to keep making this thing as good as we can. All right. But again, have a great week. Stay blessed. I'll see you on the next video.